Hello and welcome to the second episode of the Canadian Money Roadmap podcast. Today I'm joined by my colleague and certified financial planner, Stephen Guenther. We'll be discussing the topic of credit cards, the pros and cons, as well as some strategies for using them effectively. Stephen, welcome to the podcast.
Thanks for having me, Evan.
As we get started here, I thought it would probably be valuable to just discuss what is a credit card, how is it different than a debit card, and how does it actually work? Can you give me a little bit of insight there?
Well, yeah, thanks for having me on the show today. Well, I've always heard the joke that a credit card is like free money, which is nothing further from the truth.
Hold on, you mean it's not?
Well, yeah, we'll get into that.
Okay.
But no, basically what a credit card is it's short-term financing. And so effectively what that means is a credit card company like Visa or MasterCard extends you credit limit. It could be, anywhere from $1,000 to hundreds of thousands of dollars if you're, a big commercial company. But what that allows you to do is make short-term purchases on the card without paying any interest for a certain amount of time, after which interest is applied to the balance. And so the easy way of thinking about it is short-term credit.
Right. And so then compared to a debit card, you're actually spending your own money where there's a finite amount of it. Once it's gone, it's gone. But a credit card, you can borrow up to a certain limit. And then what?
Yeah. So with a debit card, you're basically getting a debit on your checking account immediately. So the pain, so to speak, is felt that day. You log into your online banking and you can see the purchase from earlier in the day is already on your account. You have less money. Whereas with a credit card, Visa or MasterCard's picking up the bill today, but then, you'll have to pay that within the next month when you get your credit card bill.
Gotcha. Okay. So credit cards have been one of those things that most people have and a lot of people use, but it's also, in financial media, it shows up all the time as one of those trouble points or red flags for people's personal finances. But before we get to some of those negatives that pop up all the time, what are some good things about using a credit card?
Well, I know a lot of times, especially if you've ever been into a financial institution and they're promoting their, in-house credit card, they often state that having a credit card, especially as a young person, can help you build your credit score. It gives you some credit history, which is true. I know in my own case, I got a card kind of going into college. And I believe actually at the beginning, one of my parents signed off as a co-signer on that card. But what it did is allowed me to start generating a credit history. So down the road, when I was looking at getting a mortgage or getting other types of credit, I was more trustworthy to the lender at that point because they knew I had history with other types of credit.
That actually reminds me of kind of dovetailing off my story from the first episode where I had to get the co-signed line of credit to buy my car. After I was finished paying off that line of credit, the next time I went into my bank, they asked me if I'd like an increase on my credit card. And it was a ridiculous increase. I think it was over $18,000 and I was 20 years old. It was crazy. So you're saying that because of a previous positive credit history, they'd be more willing to lend me more money via credit card.
Yeah, and if we jump down to one of the dangers of credit card, can be something to watch out for, because oftentimes the credit limit, credit card company is willing to offer is significantly more than what you could be able to afford to pay off in 1 month's time. And so that can create issues, especially if you see a credit limit of several tens of thousands of dollars, yet you might be earning only a few thousand a month. That's going to create a problem if you use that credit card limit without any issue.
Gotcha. So you can use a credit card well to build your credit. I know I do a lot of online shopping, and credit cards can be a really convenient way to process transactions. It's secure that way because Visa or MasterCard, Amex, whomever, will actually guarantee your purchase in case of fraudulent behavior and things like that. So that's definitely a positive to using a credit card when shopping online as well. Now, are you a point collector, Stephen?
In my personal experience, I definitely was, and that kind of informed my decisions in regards to which credit cards I should apply for or which credit cards I should hold. However, points is always, it doesn't come out of thin air, right? Somebody's paying for those rewards, and it means that, you have to kind of recognize where that's coming from. And the reality is, I mean, for at least for my experience, credit cards, just how they're built, mean that I'm more likely to spend, just in a general sense. I'll spend more than I would otherwise, partly because of what we talked about earlier, where with a debit card, you see the damage in a sense on your checking account right away. Whereas with a credit card, there's a deferral of that pain. And so what my wife and I have done is we've tried to shift back to using debit cards more often for kind of our baseline purchases, whether it's at the store, getting groceries or things like that. Whereas credit card, like you mentioned, is more so for online purchases and travel and things like that.
So the points can be a bit of a double-edged sword, where it's like you have the carrot of the point. We could go on the trip to Hawaii as long as we keep spending money on this. But that's, you can get yourself into significant trouble by thinking that way. Depending on where you bank, you might actually have to pay a transaction fee for using your debit card. So, for example, some checking accounts might have 20 transactions in a month, and that could include redeeming from the ATM or for using your debit card or paying bills. So a credit card can actually be used to avoid some of those bank fees on the transactions, because paying your credit card bill at the end of the month will just end up being one transaction out of the account as opposed to every single purchase on there. So if you don't have an unlimited transaction plan at your bank, then using a credit card can actually be a decent way to avoid some of those bank fees. Now, do you have any insight on some of the extras that can come along with a credit card? I know I alluded to purchase insurance, but anything else that you'd see as a positive for using a credit card?
Yeah, I think kind of that goes along with purchase insurance is price protection. It's something that I've actually used in the past. I had bought I believe it was a printer, and on my credit card. This was online, and it's through Costco or Staples, store like that. Anyway, I ended up finding it in a flyer a couple of weeks later for less price. But it was from a different store. So I called my credit card company because they had a benefit built in that they would basically match pricing for that exact same item as long as it was bought on the card for the next 90 days, I believe. And so that was a way that it was a price purchase protection, not just against loss or damage.
Oh, that's an interesting one. Now, you talked about using your card for traveling, and I know a lot of the point systems are based on travel as well. What other types of insurance might a credit card have for those people who are wanting to spend on their credit card in another country?
Yeah, so I'm most familiar with the rental car insurance. It can be a little tricky, especially if you're in the States. It appears that insurance and how the motor vehicle kind of insurance works differs state to state. But, if you can read the fine print, sometimes when you rent a vehicle, let's say you're going on vacation in Florida or something, you can actually use your credit card to cover off that rental for damage or theft or vandalism while you're driving the vehicle. And so you don't have to purchase the insurance directly through the carrier, the rental carrier, because you already have it on your credit card.
Another one that I've seen before is actually travel health insurance. Now, this is one you definitely do not want to assume you have with your credit card, because even if you have a travel specific card, it doesn't mean it also includes travel health insurance, but some of them do. So you can look into your cardholder's agreement and find the fine print on what is all included there as far as your benefits specifically for your card, because not all credit cards are created equal. Now, we've alluded to a few negatives in terms of spending behavior and things like that, but the big elephant in the room is the interest charge. How is interest charged on a credit card? So if I pay it off every month, am I paying interest on that?
Yeah, it's a great question. I mean, this is really where the real danger lies. And typically with a credit card, the low interest credit cards are about 11, 12%. Which, I mean, if you compare that to other types of loans, I mean, it's still staggeringly high. But typical credit cards are in the range of 20% on your money. And I mean, that is a huge burden to pay. And it takes many years to pay that off if all you're doing is paying the minimum specified payment that the credit card companies give. And so effectively, just to your question, when you make a purchase, no interest is charged right away. There's something called an interest-free grace period. Typically, it's 21 days after the billing cycle. However, it's something to be monitoring because basically after the interest-free grace period is elapsed, that's when interest starts being applied to your balance. So as long as you pay off your credit card each month, no, you don't pay any interest. However, as soon as you leave a balance on the card month to month, that's when that interest is applied and you'll start receiving, or you'll see a line on your credit card statement that's in regards to a finance charge or an interest charge.
Right. So one of the main trouble points that I've seen is that the language on your bill talks about having a minimum payment, and many people confuse that with the minimum payment needed to avoid interest, and that is simply not the case. The full balance needs to be paid off to avoid interest. The minimum payment is the amount that you need to pay to continue to be able to use your credit card. Is that correct?
Yeah, I mean, if you don't pay the minimum, it's actually, considered a missed payment. And that's trouble when it comes to your credit history, one, but also with the card company itself. And so the minimum payment is, I think, depending on your balance, I mean, it can, like I mentioned, take many years to pay off even a small balance on your credit card if all you do is the minimum payment. I know on my credit card, $10 is the minimum payment for most smaller balances that are left on there. It's just kind of a flat rate minimum. But once you get into larger balances left on the card, that will just be a function of what the balance is. And so, yeah, it's definitely not the amount to avoid paying interest. It is just simply the smallest amount that you can pay.
And so when it comes to interest being charged on the card, one of the other features that we didn't talk about yet, but you can use a credit card for cash advances. So literally borrowing cash to be used for anything else, that maybe for something that you can't directly use your credit card for, but there's a significant penalty associated with cash advances because interest is charged differently on that. Is that correct?
Yeah, so cash advances don't fall under the regular kind of interest charging mechanism that's built into credit cards. Instead of having a billing cycle and a 21-day grace period, effectively with cash advances, interest is charged immediately. And I have a kind of a funny story on this one. I had a friend who, this was college days, he was at the casino and he needed cash. And he didn't have many cards, but he pulled out the credit card.
It's not a place you want to be needing cash.
Yeah, that's you can kind of put the story together there. Anyway, he used his credit card to use a third-party ATM to withdraw $20 cash. So third-party ATM, credit card, cash advance, $20 cash. That transaction charged him $10 in ATM fees. That's through the ATM, the credit card company. And there was also a cash advance fee paid up front on his card. Moreover, that $20 started accruing interest that day. So he may have got $20 out in cash, but he may have spent $10 to $15 in costs just to access that cash.
Oh my goodness, that's crazy. And the thing is, many people, if you don't actually look at your statement, they wouldn't even realize the interest that's being charged because you don't get a letter in the mail saying, just a heads up, you're paying a pile of interest on this, because the incentive for the financial institution is to make money off you. So you have to be really careful, especially when using cash advances. Now, a few other negatives that you alluded to before: changes your behavior, meaning it's easier to spend money. There's been this theory around for a long time that if you have cash and you're spending cash as opposed to using plastic, you're actually seeing it leave your wallet and leave your hands, and there's an emotional or psychological pain associated with that. And so studies have shown that those who use cash more often, or even use their debit card to see a reducing balance in their checking account, will spend less money because of that psychological pain.
Yeah, it's called the endowment effect. And I believe it was Kahneman that wrote about this in Thinking Fast and Slow. It's a book by him. You can check it out. It's on behavioral finance. Yeah, the endowment effect is basically where if you physically own or have possession of something, the emotion that you feel when you either have to pay for something, in our case, or someone else takes it or steals it, is going to be higher because you have an emotional attachment to owning that object. And so the idea, I think they had a study on this where basically people were asked, what the value of a certain object was. And some of the people in the study were people that owned it already. They had the item. And then there were other people that did not. They didn't own the item already. So it was just, you could use any object in the example. But for the people who already own the object, they, on average, value that object much higher than the people that did not. And that's kind of the endowment effect kind of taking place. Now, we're using it in the opposite direction to say, okay, you've got physical cash in your wallet. When that leaves your wallet, there's an emotional response. And that emotional response means you're going to be less likely to overspend. Whereas with plastic, it's so simple. There's nothing actually physically leaving your wallet. There's no emotional attachment. It makes it much easier to spend. And so it's just an interesting way how you can see the endowment effect kind of play out in people's personal finances.
Interesting. So you also mentioned before that distance between gratification of, the enjoyment of making a purchase and the pain of the purchase actually needing to come up with the money. There's a huge risk of saying, I want this now and I'll figure it out later. I always have before. Why won't I do it again? So I'm just going to buy it. That is one of the major behavioral risks to using a credit card, because you'll end up placing more value over the now as opposed to your whole lifetime. Another negative that I wanted to address as well relates to the merchants that you're purchasing from, because even if you're paying it off every month and you don't pay any interest, you think, oh, Visa's not making any money off me because I pay off my Visa every month. Well, no, that's another feature of the credit card system, that whenever you make a credit card purchase, the merchant is actually paying the credit card company a fee to accept that purchase. It's a convenience feature for their customers, and that's the cost of doing business for many. But also, if you go to a local retailer, for example, and they have a little sign that says debit preferred, the reason that you do that is because all of the credit card transactions can eat into their margins and their ability to stay in business as a result. And so if you're looking to support a local retailer as much as possible, use your debit card. It saves them a few percentage points off every purchase. And in the retail space, because margins are so thin, that can really make a difference for a local retailer. Now, what if you have a credit card balance, or you just have a credit card and you want to use it wisely? What are some strategies that you could employ to make sure that you don't get yourself in trouble by using your credit card?
Yeah, the simple one here, and I think we alluded to it earlier, is avoiding interest. Credit cards have the highest interest of basically any type of debt instrument. And so what you want to do, obviously, is pay it off every month. So don't get in the habit of leaving a balance, and try your best to kind of do the math and kind of have a good understanding of what might be in your checking account. So when it comes time to pay off your bill, you can do so each month without having to leave a balance.
So what if you have a balance already? Is there a way that you can reduce your interest costs?
Yeah, there's a couple of things you can do here. We work with people on an individual basis to give them advice as far as paying off debt. It's a couple of simple ones. You may have access to another type of debt that you can use to pay off your credit card. So for instance, you might have a line of credit. You might have a home equity line of credit, things of that nature, which you can utilize to basically transfer the balance from one debt type to another.
That sounds like you're robbing Peter to pay Paul a little bit. What's the advantage there?
Well, typically on let's say a secured line of credit, like a home equity line of credit, the interest rate will be significantly low because your home is the collateral. Collateral just is, basically what the bank can sell and take as theirs if you don't pay off the loan. And so they're much more likely to give you a lower interest rate because the risk for the lender or for the bank is much lower. So that's just one simple way. It's kind of a debt consolidation strategy. But the second way, which is a little bit more dire, would be in a situation where you may not have access to other types of credit or cash. And so you may be able to apply for a lower interest rate card. So most institutions and most credit card carriers do have a low rate card the rewards and the travel insurance and all the benefits typically aren't there. But if you're paying a rate of 20% on that card, you may be able to switch to 11 or 12%. That 8% in differential will mean paying it off a whole lot sooner.
Now, there's also a few credit cards at most institutions, and maybe these are different periods of time and these things change as far as promotions go. But once in a while, banks and financial institutions will have a promotional rate on transferring balances. Because banks are a for-profit entity and they want to get your business away from the other banks. And so what they'll often do is incentivize you to transfer your balance from one card over to their card. Is that a reasonable strategy to employ, or are there some dangers with that?
Yeah, I mean, the long-term problem still exists, whether you transfer to another institution or, change cards, because, the problem came from an overspending typically, right? And if that isn't addressed on the behavior side, then it doesn't really matter what your interest rate is on a promotional card. It's going to change after the promotional period's over and you're back in the same problem. But that being said, I do have a small story on that. I know I have a client a few years ago who utilized kind of an interesting strategy. He took a low promotional rate card. I think it was 0.99 interest for 6 months. Effectively, he used it to finance a renovation on his home and then refinanced his home to get a larger mortgage to pay off the balance. And so it's not a strategy I would recommend unequivocally. However, it worked out for him. And so there are some interesting ways you can use a promotional rate or a low rate card to kind of, either pay off other debts in the short term or use it for other means.
One problem that many people find themselves in is that they don't qualify for a high enough credit limit on their main card. And so they go to the grocery store, they go to the hardware store, and they say, "Oh, would you like to apply for our credit card?" And they say, "Yes, actually, I could use a little bit more credit." So yeah, and anyways, people start to rack up credit cards. Even though they have small limits on each of them, they might have 3 or 4 credit cards that are fully maxed out. And in many cases, those department store or hardware store credit cards will have higher interest rates than the ones issued by the bank. Not always, but sometimes. So you might have 5 different credit cards with different rates of interest. Where do you start? How do you get rid of that?
Yeah, so I mean, it's a problem that we definitely come across, right? Where people come in, their debt picture is kind of a mess, right? They have all these different types of loans and credit cards, and mathematically speaking, the simple answer is you start with whatever debt has the highest interest rate. And sometimes that's as simple as it gets, or as easy as it needs to be. However, there's another method which speaks to the psychological components as well. It's called the snowball method. And what that means is effectively, instead of taking the debt that has the largest interest rate or the highest interest rate, you instead go and start with the debt that has the smallest balance. The reason being is you get the emotional high and the momentum that comes with paying off a debt first, and that can kind of propel you forward to keep going, to pay off other debts. And so like a snowball, what happens is, let's say you owe $100 a month on a small balance. Once you pay that off, now you have $100 of cash flow to utilize. So instead of going out and spending that money, you actually use that along with any other debt payments that you have to go after the next smallest balance debt. And as you can see, you start snowballing your cash flow, and it can be really motivating as you see those cards or those debts kind of fall off the books.
Any other strategies that you would find valuable for using a credit card, or ways that you can keep yourself out of trouble if you already are using a credit card?
I think the biggest thing to remember with credit cards is, if you think of it as kind of a range of outcomes, the upside on credit cards, so interest-free grace, convenience, purchase insurance, all these things we've mentioned, credit history, is relatively small when you consider the downside. And so that means that we need to approach credit cards with caution. And I think the biggest factor that you need to be able to use a credit card effectively is discipline. And so that you need to take that, do an honest assessment of yourself when it comes to credit cards and say, how much discipline do I have? Am I a good saver? Am I a good person as far as paying off debt? Has that never been a problem for me? Then probably credit cards won't be either. But if you don't have the discipline to be able to pay a card off every month, chances are a credit card is actually going to do more harm than good. And so my recommendation would be, do an evaluation of, how disciplined you are when it comes to your finances, and have a credit limit on your credit card that kind of compares to that or isn't aligned with that. So someone who has a struggle with paying off debts on time or just paying the minimum payments probably shouldn't just take whatever credit limit the bank or financial institution will give them. Now, I know there are cases where, again, you need the money for other purposes, but in general, you should have a credit limit that's in line with your level of discipline.
Okay, we covered a lot of ground today, Stephen, on credit cards. If you could summarize some of your key points and ways that you see credit cards working to people's advantages, some of the disadvantages, and some strategies for using it, how would you summarize that?
So first of all, again, if you have one, you probably do already, pay it off every month. That's kind of the common sense goal here, but it's just so important when avoiding trouble with credit cards. So that's number one. And number two is be aware of the deferral of the pain when it comes to spending. Maybe you should try, just running your debit card for a month and seeing how your spending compares to if you were making all those purchases on credit. You might find that you actually spend less. So just be aware of that deferral of the pain and know that that's an impact on your actual spending behavior.
Perfect. And then finally, if you have a balance right now and you're looking to get out from it, and especially with multiple cards, think about using that snowball method so you can really build on your success over time. A little bit now makes a big difference over time. Well, thanks for joining me today, Stephen, on the Canadian Money Roadmap podcast. We hope to see you again.
Thanks for having me.
Thanks for joining me today on the Canadian Money Roadmap podcast. If you enjoyed today's episode, I'd really appreciate if you left me a review on Apple Podcasts with your biggest takeaway. If you have questions or ideas for topics you'd like me to discuss on future episodes, please reach out via my contact info in the show notes. This podcast is intended to be educational in nature, and you should always consult your financial, tax, and legal advisors before making changes to your financial plan. Any rates of return discussed are historical or hypothetical and are to be used for educational purposes only. Evan Neufeld is a qualified associate financial planner and registered investment fund advisor. Mutual funds are provided through Sterling Mutuals, Inc.